So we got a couple of things that people were talking about. Quantica and their podcast with Niels came out recently, and I thought it was pretty fascinating. I know those guys at Quantica. I think that they're really good and smart, and they're different. They do different types of trading with the relative strength, I believe. I need Richard to fully explain his thoughts on this, but I think there's some relative strength going on there. I don't know how they put it all together. I have spent a lot of time on relative strength without any success, my research efforts. And then I think there was a bit of correlation matrix that is in there. Not really sure how they combine those two. More than likely, obviously, some volatility management. I think it was probably the first CTA that I think some of them secretly talk about sharp and like, oh no, ooh, sharp. No, wouldn't do sharp. But then they kind of do sharp, in my opinion. Some of the other ones. But I think Bruno was the first one who was pretty adamant about sharp and what else. I think the quote was, what else are you going to use if you don't use sharp? So I wouldn't classify them as hunting outliers as much as asset allocation or, well, what I just said, correlation matrix, relative strength, vol management. I don't think their performance has been the best. Those factors, putting those factors in, obviously, I think over the past few years, brute force trend following has probably done as well or better than what they've done. But they're really nice guys. I've been there. I've visited with them. I know them. They're great guys. Very smart. They showed me a good time in Zurich. And yeah. So anyways, the egg company. Yeah, we had a egg company came out and did well. So that trend is still in place for me and my foray into stocks plus all the futures markets. So, okay. And we're open to anything anybody wants to talk about within reason, I suppose. Oleg. Oh, did we lose you? Yeah, maybe we did. Okay, I'll just start inviting other people up. We lost Oleg. Oh, there he is.
Happy to be here as always. Technology is out of perfect today, and I think 2 or 3 months this technology trend for Twitter technology is out of perfect. But I'm very happy that I'm here in our trend following trading ideology school.
Okay, we'll come back to Oleg later when his technology improves. I often toy with this idea that, so during the day, I have all these traders working for me, and they're putting these trades in, and they're following the system. It's all computerized. And so during the day, I'm kind of like doing multiple different things, but I'm always kind of paying attention to the markets, unless I'm traveling or on vacation, and I've been doing a lot of vacation recently, but I'm always scrolling through the charts, and it doesn't do a bit of good because I'm not going to do anything, right? I'm just going to follow the system, let the guys do their thing, but it's always something I have to do. I don't know why. I gave up trading 25 years ago, probably, actually putting the trades in, but I still could never give up watching the markets and paying attention to what's going on, looking at the trends, the breakouts, the trouble that we're in as far as performance sometimes. Yeah, so it's I've been using Chat GPT a lot recently. I really love that, and I've been using it to find stocks. So just asking Chat GPT to show me some good stocks in different industries. I'll be riding down the road and just thinking about different industries and different products and things, and I just ask it, and it's doing a really good job. So I'm having fun finding a few more stocks. I'm almost reached my limit. I'm up to 125 or 30, so I'm going to stop at 150, and then that'll round out my 300 markets. And so I think I'm going to stop. I should have stopped at 200, but I couldn't control myself, and so maybe I'll be able to control myself at 300. It's a lot of work. It's a lot of burden for the traders to keep up with all of that. The only good thing is they don't have to spread the stocks, so they let me slide a little bit. But yeah, it's been fun. Does anybody want to talk about Quantica?
G'day, Jerry. Hello, everyone. Sorry, I had difficulty getting on today, and the sound took a while to come through, but I rebooted and came in, and it's working well. But yeah, that was a very interesting podcast from Quantica. So they're clearly a very different form of trend follower who it's interesting, actually. The more we hear from the CTAs that comprise that SG CTA index, you see the significant different interpretations of what trend is and how they're extracting an edge from their definition of trend. But Quantica was probably the most different of all I've heard so far in the series, where they are particularly focused on this relative trend. In other words, if for instance they have 100 markets, what they'll do is they will look at the spread trades across all of those 100 markets. So 100 by 100 is 10,000 different spread trades across that entire universe. And so that therefore builds their universe from 100 up to 10,000 spread trades, basically looking at the relationships between each of the possibilities in those 100 markets to come up with 10,000 in their universe. And then what they do is they establish a covariance matrix with that entire universe. And because their universe is so large, obviously they're not trading every single market. So they're adopting more a cross-sectional basis of identifying trends within that covariance structure. But clearly, their entire sort of basis revolves around this notion of the degree of correlation that exists between these their universe, and so they're particularly focused on adjusting their portfolios at the portfolio level, looking at the correlations between these, and their decisions to enter markets is based on the particular strength of the correlate or the covariance matrix, which is indicating which are the significant trending opportunities within that entire universal 10,000 to invest their monies in. And then what they're doing each day they do a rebalancing with their covariance matrix, which rebalances their entire portfolio. So they're very different to what we are, but it was a very interesting discussion. And so I'd like to hear what others have to think about it.
Well, I think it's interesting that I hear this, and when people talk about their trading strategy a lot, that they're so heavily influenced by where they came from initially. And with Bruno, I think he was obviously not a finance field, and he brought over his PhD and his knowledge in math into trend following. And I think that for most people, that kind of is going to set the tone for where you're going to be able to go. There's a limit to what we can all get out of our past and evolve from our past, maybe. And so I think that a lot of the SocGen CTAs, the 20, they come from these highly scientific or mathematical or physics backgrounds, and that's going to have a big influence on trend following. The trend following is not going to overwhelm their background as much as their background is going to really start influencing the type of trend following that they do. Now, Richard Dennis, of course, came from trading in the pits, and his partner Bill Eckhart was was working on a PhD in math in the early '80s. And I think some of the some of those guys that are in this one group in particular, they continue to put out like incorrect information that basically Rich was a pit trader, and then they just had these ideas and they coded them or got someone else to code them. But honestly, it was very high level at the time, and it was a lot of computers and math involved. And Rich was super smart, and Bill was incredibly genius as well. And so it wasn't really a pit trader. It's just marketing for these guys to tear down the turtles a little bit. So I was lucky that I came from basically trend following only, or trend following, just doing trend following initially. So I didn't have this, for better or worse, this background of, that I was gonna have to. It was going to influence my style of trend following. I was like basic core classic trend following from the very beginning. So whoop, there you have it. I haven't really deviated so much from that. And then this is a little confusing for me, but I don't think it's 10,000 markets. It's I forgot the equation. It's 49 times 50, or 49 times 50 times 99. It's not 10,000 markets because because they offset each other. You can't go long and short. You wouldn't go long and short the same two markets, the same two combinations. So so I don't think it's 10,000 markets, but I could be wrong. What do you think, Richard?
The way I understood it was that he was looking at 100 discrete markets, and then what he was doing is he was looking at, let's take market number one. He was then looking at the correlation between market number one and market number two. That's a distinct possible return stream. He was then looking at correlations between market 1 and 3, 1 and 4, 1 and 5. So when you look at that combination, you get 10,000, 100 times 100, you get 10,000 possible return streams. That's not saying he's trading them all. That's just saying he's creating his covariance matrix with that 100 times 100. So it's looking at the relationships that exist between the markets. In other words, he's looking, a 60-40 portfolio is, such effectively a spread combination of a 60% equity and a 40% bond. So he's looking at the relationships of the price movement between all of the various markets, how they all work for every single individual market in that combination of 100. And that's giving him information for his covariance matrix that then says, well, how correlated are these markets? He's looking at the relative strength of that covariance matrix. So he's saying there are certain trends like the S&P 500 was the example he gave us that stood out as the strongest performing relationship when you look at the 100 different variations of S&P against all of the other markets. And that clearly showed that it was S&P that was driving the trend. And so their decisions would be to take a position in the S&P. I'm assuming they're both long and short. I'm not sure about Quantica, but I'm assuming he's also doing it with the short opportunities as well. But that's how I see it, but others might know better. I suppose a way to look at it would be a relative strength matrix, effectively. That's what they're creating, a sort of relative strength matrix, and their decisions are rebalanced each day based on how that covariance matrix is adjusting or changing, which therefore means that they are particularly dependent on correlation histories, particularly at the medium to the long-term level, because they're not concerned with the daily. Whilst they're rebalancing daily, they're always talking in terms of they're looking at the medium-term volatility, the medium-term relationships of the covariance matrix. So whilst they're rebalancing daily, I think they've got very slow signals. I'm not sure. Brian, you had a listen. What are your thoughts?
Well, I bring the the grain aspect where spreading is quite common. In fact, you can be short corn front month and long corn new crop, and it trades very. I mean, you can use a trend following system to trade the spread successfully, or at least you can in the grains and those closely correlated markets. And you can both trade intercommodity and intra, the contract months successfully, and that's quite common, and we do that. But some of it resonated with me, and some of it I kind of thought was things that didn't resonate with me, and I was like, oh, I don't like that. And then other aspects I was hearing, oh, I do like that. And I actually thought of Moritz, because I know before he was right toward the end of his regular appearance on Top Traders, or the SIS series, he had commented that he was trading spreads effectively with trend following as well. So I would be interested in how that's bearing out for him, because I know it works in interest rates and grains and the energies. So anyway, I it resonated, and the tried and true, or as Jerry said, the brute force trend following, it works across these markets.
Yeah, he was definitely saying that they're using a combination of cross-sectional and absolute momentum. In other words, the individual trends of individual markets they do take note of, but their signal generation is not just a combination of those that are displaying absolute momentum. They're then making a decision of what to invest in via a cross-sectional basis, I think. So I'm seeing sort of a touch of their cross-sectional sort of coming into their signal generation, and once their signals have been generated, they clearly then step onto the next phase of portfolio creation, which is very much looking at that covariance matrix to assign weights and position size, which adjusts daily based on the information coming from the portfolio from that covariance matrix.
Okay, sorry to bother you, but I have to go back to this algebra question. And 100 markets, there's not, it's just semantics here, but 100 markets is not 100 different, 10,000 combinations. It is 10,000 times 0.5. Oh, crap. I'm confused. Okay. Well, anyway.
Imagine three markets, Jerry. If you had three markets,
that's right.
Just think in terms of three markets. Then exactly, the combinations.
That's exactly what I have on my example. Three markets is not 9 combinations. It's 3.
I think it is. So imagine it's 1 and 2. It's 1 and 3. It's 2 and. Oh, you might be right. You are right, Jerry. You are right. You are right.
So it's the total number, which is 3, and you take 3, and it's 0.5 times 3, and then it's 3 minus 1, and so you multiply those together. So it's 100, which it's 50 times 99. That's the equation, and that's the possible combinations, given that 1 and 2 and 2 and 1 is the same thing.
It's 3 to the factor 2, isn't it? 3 to the factor 2. That makes... maybe not, sorry.
Yeah, it's 3 divided by 2, which is 1.5, and 3 minus 1, which is 2. 1.5 minus 2 times 2, that's 3. And it's the same way here.
I'm going to ask ChatGPT, Jerry.
100 divided by 2. The reason I know this is because I've done this type of research. Like, you don't even understand, you wouldn't even believe how much time I have spent on this project. And I think I'm going to guess, this relative strength thing is, maybe it's not exactly this, but it can't be too far from this. And anyways, it's just simply dividing these markets by each other and then putting it on a chart and seeing which one's in an uptrend, which market, if that sort of synthetic spread is in an uptrend or a downtrend, and then applying the system to corn divided by soybeans or corn divided by S&P. And now, obviously, since I'm so focused on the trade, the discrete trade, entry, exit, stop loss, and counting those trades, my inclination was the only way to accomplish this relative strength idea in a robust way was to divide all the markets by the other markets, not 10,000, but not 100,000, but I think it's like 9,000, and then create this synthetic data of just like in a currency spread, British pound divided by yen, that's a market. So let's create a synthetic market, corn divided by soybeans, and then all the combinations, everything. And then you run that as a trade, entry, exit, stop loss, and then you preserve the sample size concept. You just have to, at the end of the day, net the positions out, net the trades out. So you wouldn't do a trade in, some markets you're going to go long British pound. In some markets, when you do the spread, you'll be short the British pound. So you have to net out the position. So it's heavily computer. It needs the computer to do all this grunt work for you. And so I've spent like years working on this project, but only in that particular way, where it had to be this trades, and I'd have the trade stats, and I would count up the sample size in the same way that I do my regular trading, where I don't do these spreads. And so I couldn't get beyond this idea that if I'm willing to, my analysis says, yes, it's okay to trade sterling yen, then why isn't it okay to spread other markets? And it's not. It doesn't work. And I wasn't willing to make this sort of general compromise that I will just sort of do it as an extra step and layer like an overlay kind of, and not do it kind of on a trade by trade basis. And we've talked about this on the spaces about this type of spread trading. But don't you think that's in essence what they have to do, Richard, is that it's kind of spread trading. It's not in the way that I described it, but at the end of the day, you're just dividing two markets by each other to see which one is stronger than the other.
I'm still trying to get my head around this because he definitely gave his example of 100 markets comes to 10,000 permutations. And I'm thinking at the moment, what we're talking about is pairs. But what he might be looking at is, say if we had three markets, the relationship of one market to another market, that's a pair. You might be looking at one market to the two other markets. You might be looking at one market to the three markets. To look at those possible permutations. In other words, getting a covariance matrix is not just related to individual pairs of markets, but across the entire portfolio. What is the possible number of permutations from 1 up to 100 possible permutations? I don't know, but he definitely gave that example, which it strikes me as funny because he's obviously an expert at this, and why he gave that example, I'm not sure.
Oh, he gave it more than once. So yeah, I'm sure it's not the way I described it. But as we know, the possible combinations of three markets is not 9. So you don't multiply 3 times 3. So it's the equation I said. So the possible pairs, yeah, we don't know how pairs differs from what he's doing. It sounded like pairs to me, but it's 4,950. So it's 99 times 50. And so that's the possible pairs. But what was my question I just asked? I was wondering if you had a comment on. Maybe he's not doing it. Simply dividing the markets by each other. Dividing each of the possible pairs, and then seeing which one is stronger. I mean, how else can you do it, really?
Well, the way he said it was that they normalize the volatility of each market, so each market can be treated the same. I like that principle because we do the same in our models, and that therefore allows them to apply the same model across any of the markets in their portfolio. And he said they've been doing this; they've never changed their process for the last 18 years. So once they've normalized their markets, I personally think they're probably looking at the return streams. So they're looking at the covariance matrix of the returns generated from their signals rather than the price or the market price. So in other words, let's assume we had a $1 bet in copper and we had a $1 bet in corn. Then the relationship of the $1 copper and corn, they'd get a return stream. They'd then look at a $1 US 500. They might get a $1, I don't know, Swiss yen or something like that, and get another return stream. So those return streams, they're normalized, so they've got an equal weighting. And then I think they're getting their covariance matrix from their signals, but could be wrong there.
Oh yeah. I can't believe I forgot that. That's right. They do the normalization of the data. Now, yeah, I don't like that, and I don't understand why that's even necessary. So now you said you do that, but
Well, I do that with ATR. So, when I'm using, let's say I'm trading cryptocurrency or I'm trading a bond or I'm trading the S&P 500, I do normalize with ATR. So I say, I want to risk $500. I'm using my ATR to define my stop level, which risks $500, and then that determines my position size. With that, it's a fixed fractional method I'm using, with a fixed risk effectively, but using ATR, that normalizes my trade so that I can trade my models on cryptos, on anything. So I think they're doing a similar thing. They're normalizing their trading models so they can apply it across any particular return stream.
okay, so yeah, I don't like it. It's not something I would want to do. I don't think it is very similar to what we do. And so essentially, and I've been sort of preoccupied with Quantica for a long time. So I have tried to understand what they do. And I don't know if you and I have ever shared papers, but I for some reason, I feel like I have forwarded you.
You have, Jerry. You have.
In my Quantica file. But yeah, it's that too. I almost forgot that. Yeah. So, okay. So my interpretation, and this is what I think it is. And that is, instead of looking at the chart and saying, oh, we're at a 100-day high. Now, we're going to do this trade. What's the ATR over the past X days? We use our ATR. Some people use 15, some 20. Okay. And so you respect that chart price, the actual prices, what's continuous possibly, and then you calculate in the second step, based on ATR and your AUM and your unit sizes, this is the quantity we're going to do. No, not for Quantica. No, they changed the data. So the market was not up $1 yesterday and $2 the day before. It was up a half an ATR yesterday and a full ATR the day before. So it becomes an ATR change type of a chart. So that makes me a bit nervous. And I'm like, why, right? We're introducing ATR. It's not like the greatest thing of all time, but maybe it'll give you slightly different breakouts or moving averages and trends. But is it really a better in-depth way of, oh, this is a really good trend because we've changed the data to reflect ATR movements versus actual price movements. And then, this is another little problematic thing. One of the things about trading that is very important is to do the same thing every time. You want to do the same thing. You want to buy that breakout, the same one all the time for the rest of your life. You want to exit on that breakout, the same one for the rest of your life. You want to have a constant unit size for each market. You don't want to take markets in and out. You don't want to change things a great deal. You want to have the same calculation for ATR all the time. Just pick something and stick with it, and don't keep making all these changes. And so that is usually the most important thing. It's not like my ATR calculation is better than everyone else's, right? It is. I came up with it myself. I love it. Okay. But really, the power in that ATR calculation is really just not changing it and continuing to do it all the time. It's not going to really make that much difference. Okay. So one of the things that I dislike is how do you calculate that ATR each day? Well, it's that day's ATR. So it's changing every single day. Like, I look at charts in terms of, I have graphs on my screen, on my charts that show how many ATRs did a trade make or lose today. So I take the current ATR, today's net change, and divide it by the current ATR. But the current ATR calculation changes every day. And it gets weird because if it's been a lot of big days, then if I get another big day that was just as big as 2 weeks ago, it's a smaller move in terms of ATR than it was 2 weeks ago. So to me, it's just opening up this can of worms. Like, why adjust this data? I really don't understand why ATR adjusted data. Oh, well, it's really complicated and takes a lot of, and maybe, it helps earn the 2 and 20. So, but yeah, that's another thing too. I don't really fully understand. Honestly, I wish their performance was kick ass constantly and consistently and better than everyone else's. And I would probably spend more time trying to figure it out. But I probably do try to figure it out when their performance has been the best. But we've been in a stage recently where turtle trend following has been about all you need and not too many bells and whistles. But yeah, do you understand why any sort of benefit, Richard, of altering the data and measuring the breakouts or moving averages on this altered data?
Yeah, look, I'm starting to accept why they're doing this, and this is where we differ. So I'm not saying you and me differ. I'm saying the classic trend follower differs from them. So what we're focusing on are these things called outliers. Now, I noticed that Quantica didn't mention once about outliers in their process. That was never mentioned. They are looking at alpha coming from trend following based on what I believe are the correlation relationships between markets. They're not concerned with outliers. That therefore places them in a different category to us, and it means that they need to adjust things continuously in relation to their correlations or their covariance matrix. So effectively, it's putting them in the camp of, effectively the dynamic position sizes and the volatility adjusters. It's putting them in exactly that same camp because I'm starting to see why they're doing it, because they're not extracting the same edge that we're extracting. We are disregarding the 90% of trades and only focusing on those 10% of trades. Now, that's because we know that most of the meat is, for our particular process, is found in these outliers. But for other programs that are not focused on outliers, they're focusing on a large portion of the Gaussian distribution and the trends that occur in the Gaussian distribution, which are sort of, to me at least, that's where correlation, dynamic position sizing, volatility targeting, all of these things make sense, because it's much more of a predictable trending environment. Trends are much more well behaved, correlations are much more observed. But in our areas of outliers, where all hell breaks loose, correlations break down, there is no sort of single mean, there is no single standard deviation. The predictive processes required for these other alternative, more complex models, which are trading on a different form of edge, they struggle in our environment, but we would struggle in their environment. So I really believe not all trend followers are alike, and Quantica really stick out as a sore thumb to me as someone who, they entered their trade without sort of looking at what other trend followers were doing. They came up with their own opinion of what's trend. Their opinion of what's trend might be more similar to Howard's. Trans trends, sort of idea of trends and, dominant trends and their influence on other markets and those sort of things. But that's not what we are sort of interested in. So we are interested in very simple models because we have very chaotic markets to deal with and chaotic outliers to deal with. And there is no sense to us applying volatility measures, correlation measures, all of these things that get us into trouble in this sort of unpredictable world of the tails, whereas these other trend followers certainly do perform well in much more predictable environments, but flounder when they're in these tail regions. And I expect to see Quantica's results similar to the other CTAs. I expect to almost see double-digit losses this month. They did say that they weren't as strongly affected as, or they were affected to the same degree as other CTAs. So when the correlation snapped with the fixed income sector this month, I think we're going to find, when Buffett said we find, who was exposed when the tide goes out, who was naked, I think we're going to find those people that do rely on backtests, do rely on quantitative data, do rely on more predictable conditions, do rely on correlations. We're going to find that they're going to offer probably worse returns than, say, the classic trend follower that wasn't probably as significantly hit in March. It's not to say that always those conditions will persist. There'll be some times where they win, sometimes that they lose, but I think that's where we're going to see this dispersion in CTAs and be able to identify who's doing what.
Right. I think it all has to get back to exactly what you say, and that is that, I think you and I come at it from slightly different points of view. We like to emphasize different things, and you emphasize this idea of it's too prescriptive. You need to have loose pants, and they've sort of overfitted to the past a bit, and the future may look a lot different. And then I agree with all of that, but my shortcut is it's got to just be sample size. And so it makes me nervous to have all of these different moving parts in something where, and to focus on this Sharpe ratio thing as well, that you're just going to miss these big trends. And it's just not the way Neil says it. It's just not. I mean, I've disagreed with him on the podcast, and this is the one thing I disagree with him more than anything, or anyone who has this idea, and that is, it's like it's not all created equal. It's not all created equal. I have it wrong and they have it right. I much prefer that outcome than to try to convince myself that, I can just jerk around in these markets and do this crap and have my own opinion and add this stuff to what I'm doing all the time. And it's not going to matter to anybody. It is going to matter. It does matter how you do things. And you can go a long time. I've done this before. I went a long time with very unfortunate elements in my trading system that never caused me any trouble. Then all of a sudden, it caused me a lot of trouble. And I think this is how the markets kind of work. You can get lulled into thinking that overtrading, over-optimization, overfitting, hey, I don't really see a problem. I tend to do just as well as everyone else. No, I think, yes, so far, but maybe not in the future. And I think you need to be very concerned about, it's not like you and I definitely do not believe that I have two choices. I can vol manage, correlation manage, do all of this sort of stuff, and do what I'm doing now, which is plain trend following with the hunting the outliers, one entry, one exit, and stop loss. Just flip a coin, do whatever you want to do. I just don't believe that's true.
Well, I think Absolute brought it up last week, and it was a very good point. We do. Whilst we talk about being exceptionally diversified, we're dealing with when we're dealing with our realised balance, we are exceptionally diversified. But when we lock onto those outliers, we become extremely concentrated. So with that unrealised equity, we're riding with some magnificent profits. So I was looking at my orange juice and London sugar today, and the concentration of my trades in those particular markets and the unrealized equity in those markets is so significant. It dominates the portfolio. But that's a concentration I'm prepared to live with, because that's risking what I'm regarding as my unrealized equity. Like, I'm solid in protecting my realized balance. But if you ask Quantica, or if you ask Howard from Transtrend, or if you ask those other CTAs, do they agree with what they're doing? They'd be saying, that's madness. You're risking so much of that unrealized equity. How can you do it? But then I think to myself, I go back to the classic gambling situation where the anti-martingale, where we've got nothing to lose with risking our unrealized equity. And that's where, in unpredictable markets, we can make such significant windfalls because the market allows for that. And I think in the long term, we're going to find that we will perform incredibly strongly, particularly if markets get more chaotic than they are now, or they have been over the last 30 years. So we haven't sunk in the water over the last 20, 30 years using classic trend following. We've performed as well as the rest of the industry. But I think you'll find if markets get more chaotic, that's where you're going to start seeing that our method is superior in more chaotic regimes. Because that's where quantitative modelling and all of the science that goes into the mathematics of most of the risk management controls, vol controls, all of these things applied by the CTAs, that's what's going to get them into trouble when they suddenly find that their models and their thresholds and their expected returns are no longer respected.
Okay. Does anybody else want to weigh in on this before we possibly change the subject? While you're thinking about it, go ahead and interrupt me, because I'm just going to do a little filler here. I was interested in, I can't figure out how DBMF is doing this year, and if it's, and I think it's underperforming. I don't know if it's tremendously underperforming or underperforming a little, but the markets were crazy chaotic, and probably the 1 week rebalancing, running the replicator once a week, that idea probably hurt them this month, or the 14 markets, only 14 markets. But I'm pretty sure he's underperforming. Assets are down to 750 million. And a lot of that is just due to the drawdown. So I'm not sure, if I don't have those numbers in front of me as to, and all he wants to do is outperform the SocGen CTA index. So I'm not really sure how much he's lagging behind that. He certainly wants to make money, but his mandate, his business reason for existing is, I can beat the SocGen 20, at least match their performance with replication, and you don't have to pay the incentive fee part. So I don't know if anybody's followed that, but there was a posting yesterday that someone put out there that I think that people, oh yeah, this was kind of funny. I get this text message, and my friend, he tells me, I'm out in LA at this conference, and it sounds like they're all bashing poor DBMF. I love Andrew, I love DBMF, I love what it's doing. I think it's funny. And I think replication is probably okay, hard to say. And it's done well so far. And he says that these people are telling me in LA that you like Andrew. And I thought, he says, could this possibly be true? I was like, yeah, where have you been? Of course, he's great. What's wrong? There's nothing wrong with replication. I think it could work. And it's been working. And I've already said, though, I wish he traded more markets, and he may end up doing that, more than 14, and he may end up rebalancing more often than weekly. After this month, who knows? Or he just says, "Hey, look, we've seen this before in the data, and we're all relying upon data, right? And we're all relying upon back test, and we're all relying upon smart people to run our computers and math people to help us devise our systems, which is exactly what this guy has done." But now, oh no, we don't like the way you do the math and the way because you're making money in replicating us, so we don't like that, So whatever. But one of the things, so then this guy posted something, and he basically said it's a lot of nonsense. But the one part I think is nonsense. I wanted to run by the more math experts on Spaces today, and that is he says like. Something like this doesn't have money management. So you probably don't want to invest in a fund like this replication because CTAs who are very experienced, they have money management. And I'm thinking, I don't know anything about replication. I can't do this. But come on, the money management is manifested in trades that these 20 CTAs do, and then the resulting positions, which Andrew picks up. And so he has their money management. He has the money management, the entries, the exits, the unit sizes that they have as a group that allows him to replicate the group. And so the one thing he doesn't want to do is have this overlay of any kind, call it money management, whatever you want to call it. He doesn't want to have Andrew's rules on top of the replication. That is total disaster. And I think my friend, he knows that. Yeah, he knows that. So it's kind of unfortunate that there's plenty of criticism for replication. And I've mentioned some of them already. The number of markets, the update weekly, and other things. Okay, whatever. But I don't think saying that it doesn't have money management is valid. What do you think?
Well, he's always caught. Yes, whilst he's replicating the CTA's positions with his 14 markets, he is exposed with his lag. And so in that lag, might be a week lag or whatever, there can be significant adverse movement, which he won't be able to manage if he's simply replicating their positions. So I'm always a bit worried about the risk management side of Andrew's technique. Look, I really like Andrew. He's a great guy, and I wish him well. But there's a couple of things I don't like. I don't like the fact that the reason for the ease of replication is basically because the industry has been forced to forced to reveal their positions through regulation, which has therefore allowed copycats to come in and sort of look at that data and replicate those positions. I actually think that I'd prefer a world where the industry reported monthly and didn't have to report daily. And so I don't think the regulators and the regulator environment just really assisted our cause, because it just therefore allows replication methods to prosper, which is really reliant on the skills of the people that they're replicating. So it is, to me, a form of, I don't like it, because that's an unfair playing field for me. But I do wish him well, and I just feel that it's going to be, he obviously has a significant cost benefit for his ETF, which will always give him a slight margin, but during chaotic regimes such as March and things like that, we certainly probably will see a massive dispersion in his results against that CTA index, even though I'm not so concerned about him copying the SG CTA index. I would be concerned if he was copying, our classic methodologies. But, I'd like to ask Andrew whether an ETF could be constructed using a fund-to-fund structure of classic trend followers, where instead of replicating, we simply invest in the programs of the fund-to-funds via an ETF. Therefore, we're really relying on the skills of the collective in the ETF structure as opposed to a replicating model. And if that can be shown to demonstrate significant outperformance over the long term, why wouldn't that be a significant opportunity for Andrew and his team to sort of invest in a model like that?
Yeah, just to clarify, I think you misspoke when you said positions, but they don't show positions; they show net return. So he has a bit of work to do, and that's the reason it doesn't work. I mean, if they actually showed positions.
Yeah, sorry, Jerry. Yep,
yeah.
You're right.
Yeah, and another thing too that makes it easier to replicate is that they vol manage and vol target. So they don't really get the outliers. This past year, when, just for an example, not a great example, but when you see the yen and the pound at one time be the big outliers in the currency downtrends, or the short-term interest rates, what used to be called euro dollar, and those short-term interest rates were the bigger outliers in the interest rate shorts. They make it easy for Andrew because they reduce those positions. They're getting too volatile. They're making too much money. We have to get rid of that outlier. The outlier is a problem. So with me trading 300 markets and me getting an outlier in a French fry stock, that's going to have a material impact on my overall performance because I'm not going to vol manage it. It would be harder to replicate me, and it's harder to replicate any individual manager. He gets. I think it's easier for those two reasons. It's a group of traders. He's netting out all the positions, and he's getting to the bottom line of what the netting is. It's only 14 markets, so that makes me nervous. And they're not hunting outliers, so it makes it a little bit easier for Andrew. But I'm sure in the data that he back tested that he's seen situations like this where he got unlucky and underperformed, and then he probably gets lucky and overperforms sometimes as well. But I think to some degree, this particular SocGen CTA index, I think that what Andrew provides is the only way to invest in all of these guys. And then I don't think that he's really ripping off any individual manager. And probably there's not that much of a market for, obviously no one came forward. SocGen didn't come forward with a fund to invest in, even for high net worth people, for all 20 of these managers. So I came up with this analogy, and then I thought about it. It's not a very good analogy, but so I'll say it anyways. But I guess I need to come up with a better one, because initially I thought I had something interesting, which was it's like the S&P 500 and the individual stocks that did really well getting pissed that S&P is making this money when it was the FANG stocks. So it's like the FANG stocks getting very upset, that they're getting ripped off by the S&P 500 because people buy the S&P 500. So it's not a good analogy, but I really don't think that there is there's so much the CTAs could do that they're not willing to do except complain about it. So I don't really have sympathy for either group. I think it's funny to watch and it's interesting. And I think it's just amazing that it went from 60 million to over $1 billion last year.
How are you, Alp?
Hey, Richard, how are you doing? Hey, Jerry. Hey, hi, guys. It was a very interesting conversation. I just, this week I've listened to Winton conversation on the Top Traders Unplugged, And one of the things that I found interesting is, what David Harding, because the guy mentioned, Simon has mentioned basically the fact that David Harding's quotation saying that in 2018, I guess, that the trend following returns are a little bit front loaded. So the Sharp has reduced over the time. So, to be able to get back to that sort of a better Sharp profile, you need to become a multi-strategy platform. And that was very interesting for me, just to observe that some people, because of the drawdown profile, decided to employ non-trend strategies, and so there's a market for that. And they got 10 billion under management, and it was I just said, wow, because 10 billion is still not that big. 10 billion is not like 100 billion. They can allocate. They can do some creative thinking with it within the trend and keep everything else within the trend. But it seems that they do have a change of hearts, and I find that part interesting. And also, when they were talking about adding the new markets, when they were talking with Niels, so basically their view is the new markets needs to be alternative markets. So they definitely have a very strong opinion about not trading equities as part of a trend following strategy, and they would like to keep it as an additive process. So that's an interesting view. I mean, we've discussed trading natural gas, the European natural gas, the European wheat, and other less liquid commodities, interest rates, and some FX as well. But I just, I'm for me, it is a very dogmatic way of approaching to the trend following when you say that we don't want to be, incorporating trend following with the mainstream equity and bond portfolio. So, definitely their view is that. So it was interesting to observe that, and but that's where I am at the moment, and I'm curious to see the results of March as well. So it was definitely an interesting month for many CTAs. So that's the update this week, Richard. Thanks.
Yeah, I'll tell you, it was very interesting. I've noticed that all of the very big CTAs, those with 10 billion, 6 billion assets under management, they are very client-centric. In other words, they're not basically saying this is the investment you need. They're basically saying, what do you have and how can we assist you? So it's a business model. It's allowing them to achieve far greater AUM by accepting the fact that, they can assist a client with their investment. So they listen very carefully to what the client wants, and then they structure a portfolio accordingly to achieve a good Sharp. So all of those big ones, that they tend to say, oh, we love Sharp. And I noticed also that Quantica loves Sharp. But that to me, when people say they love Sharp, that immediately tells me that they're prepared to dabble with alternative strategies, multi-strats, to smooth that equity curve. But in the process, I truly believe that they are sacrificing the opportunities associated with what an investor really needs, the medicine they really need, rather than what they want. And that's this lifting power given by the outliers. So, I ran a hypothetical model where I did a 30-year scenario where I looked at a monthly return series where I increased the monthly return. Well, I treated each month as a 1% return. In other words, no drawdown. So I then compounded that series and I got a Sharpe of 20. So over that period of time, there was no drawdown because each month we got a 1% return. And then when you compound it, you get a Sharpe of 20. Then what I did was I said, right, now let's insert some step-ups, beneficial step-ups into that model. So there still was no adverse drawdown, but we got significant step-ups created by outliers, where you go 1, 1, 1, 1, 1, and then suddenly you might put in a 5, 1, 1, 1, 1, 1, then you might put in a 10. Then you compound that series. And the Sharpe goes down to 2, but you've got a significantly increased worth at the end of the exercise when you compound it. So that tells me how stupid Sharpe is, because it's basically penalizing what we call beneficial volatility. So that means that when you are as a portfolio manager, when you are selecting for Sharpe, you are therefore eliminating those models that are actually contributing to your net wealth through this lifting power from step-ups and the outliers, because that's being penalized by Sharpe. So they're looking for models that don't do that. And therefore, they're getting further and further away from classic trend following as they try and appease clients with these nice, smooth, Sharpe ratios. And they're slowly getting less and less focused away from the tails. And sooner or later, you're going to find that they're going to need tail protection in their strategies, because they've migrated so far away from the tail properties. And they're going to require tail protection as an overlay, because they find themselves exposed during these periods of time, these chaotic periods of time where we do get these tail events.
That's right. And I'm okay with multi-strat or whatever, right? I mean, that doesn't offend me, I mean, whatever. But don't screw around with my trend following. Let's do the trend following the way it's supposed to be done. And then whatever, invest in some other things if you have to, or some other strategies, okay. But they have to bring in Sharpe. Whenever they're talking about things, it's implicit. He doesn't even say, he just says it's gotten worse. So the follow-up, how would you say it's gotten worse? Why would you say it's gotten worse? Well, it's risk adjusted. Oh, risk adjusted. So in our idea, it's a faulty measure of risk, because you just put it more eloquently than I've said it, Richard, and that is, Sharpe doesn't translate into real risk. It doesn't translate it. You proved it. The Sharpe went way down, and not only did you increase your risk, but you probably lowered the risk and you made a lot more money. And you didn't take a back test that was purely based on anti-trend following principles, and then marveled at how smooth it was, and then said, let's leverage that up. Oh my gosh, you got this wobbly chair that you're going to leverage up now, which is exactly what I do. With 50 markets, you trade 4 units. With 100 markets, you may trade 4.5 or 5. And I'm continuing to leverage up because I'm seeing the benefits of adding more and more diversification. 1,000% robust, no trade-off, no opportunity cost whatsoever. Continuing to layer on more and more features that improve the back test and improve the risk-adjusted return based upon Sharpe or some sort of vol. And you're going to congratulate yourself by saying, and watch this, I can leverage it up even more because the Sharpe is increasing. Yeah, you can see where that's headed.
So one of the other conversations that I also found is interesting. I was listening this Quantica conversation as well. I think they discussed this, the crisis alpha, whether trend following returns better during there's a crisis. But, a lot of the interviews, they specifically mentioned the fact that they don't like the crisis alpha concepts. And I think in Quantica interview, they mentioned the fact that the magnitude and the duration of crisis is not defined, and Niels has mentioned that term has been originated by Katrin Kaminsky's definition. So actually, it definitely meant something else, and he was emphasizing the certain prerequisites like opportunity being one of them, and so I find it interesting, in the sense that tail hedge, whenever there is something else, a big black swan is happening in the equity markets. So a classic trend following usually do well, so really, I'm not quite sure what you think about crisis alpha. Trend following likes a good crisis. 2022, 2023. These are usually good years. Much way better than the 2009 to 2019, where everything else has been suppressed by the central bank intervention, and the only thing that really trends is the single name equity. So, from that point of view, I think I'm not quite sure why they don't like to define crisis. It's maybe there are certain crisis environments that they cannot provide alpha. Like they were talking about 2018, where the stock market got up slowly, but then there was a very sharp reversal, and the Winton manager was also talking about the same thing, and they were talking about they've learned lessons from looking into the 2007, where there was a similar environment where the equity market has gone up slowly with low volatility, but it has come down sharply. So they were possibly responded better. So yeah, I think trend following doesn't do well in all types of crises, but it's just there is no cost of employing it, so you're much better off allocating some money to trend following, because there's a good chance that it will do good in I would say at least some of the crises that we have seen in the last 20 years. I mean, I'm not quite sure how Jerry Parker or Richard have performed during 2018, but apart from 2018, there were other crises during the last 20 to 30 years, and the track record is very solid, I think. Thanks.
Yes, Alp. I was slapped in the guts in 2018 with a short, sharp correction. I was slapped in the guts with Volmageddon, but I've thrived in this one in March. And so I've done a fair bit of navel gazing there. And I do agree with Bruno from Quantica in that the assumption is if we state that we offer crisis alpha, then the expectation by investors is that however they define their crisis, our trend following models should be performing well. But that's not the case, because in sustained periods of crisis, yes, we do very well, but in short, sharp corrections, we do badly. But that's where a tail risk protection strategy will always perform, say using options or whatever, or long vol. And so, yes, tail risk protection offers crisis alpha, but our models aren't guaranteed to do that. So we look over the long term and we find that our returns are uncorrelated with alternative markets and asset classes. But what we find when we drill into the detail is we find that it's not always uncorrelated. In fact, during the times that we prosper, we can be incredibly negatively correlated, like during 2008, and during the equity crisis events. But we can also be positively correlated during boom times when markets are all strongly trending. So it's a bit of a furphy to assume that we offer crisis alpha all the time, because we're forgetting about the upside during boom times. So trend following can work really well during booms, and it can work really well during busts. It just doesn't like those environments where no trends are present, or when we get short, sharp corrections with our medium to long-term models, which can get us into significant whipsaw environments and do a bit of damage in a short term. If those corrections turn into major crises, we tend to sort of, come out the other side looking fantastic. But if those corrections are maintained, like, if we had a 2018 event in a protracted basis over multiple years, we would have been severely damaged with our models. And those regimes can occur. So I tend to think that when we do, we need to learn lessons from these short, sharp corrections, because they are things that we don't handle very well. But I have noticed that my models seem to be handling it a lot better. And I have a feeling it's because I'm using an adaptive process where all of those events are slowly, progressively being built up in my models, so that when I'm doing my annual refresh with my models, it's incorporating those events and adjusting the models accordingly. I know Jerry might not like that, but I certainly need an explanation for why I've done well this month, because I wasn't overly exposed to bonds. But my expectation is that, why would you be overexposed to bonds? Well, you'd be overexposed to fixed income or bonds because the backtest has told you that's what you should invest in. So I think there has been a bit of over-optimization with a lot of these trend following programs over the course of time, because they're using these quantitative models over the long term, which have therefore, positioned fixed income as a major segment of their portfolio. But I think that, the classic trend follower, with their risk mitigation measures of stops and small bet size and maximum diversification, over the course of time adapts, because the more they diversify, the more they have small bets, the more they keep to their rules-based process, the less impact these corrections in a single asset class will have on their models. It's only when their entire portfolio is affected by these corrections, which is a very unusual event, that they'd suffer. So, the more we diversify, I think the more we protect ourselves from the impacts of these corrections, even though we're using medium to long-term models.
Thank God for that last part, because I agree. I love all of that. That's exactly right. I mean, it's just so perfect. I don't really, I had a dream last night. I woke up and I was having these dreams, and I think it was trend, a question grilling me about, why don't I change my systems more? Why don't I have more analysis, and why don't I update what I do more? But so I thankfully woke up and didn't have to continue that process. But yeah, I think the way we, it's a total no-no. I mean, it is a total no-no to trade more bonds because they've done better in the past. That is an abuse and a misuse of a back test. And so I had to ramp up my stocks from 50 stocks to 150, and for instance, and over time, over the past year or so, I've been doing that, and I have to choose stocks and put them in my portfolio, and then start trading everything else a little bit smaller, not to increase my risk budget. And I didn't pay any attention to any historical backtest on adding any of those stocks. I added them only because of the diversification quality that I thought that they had. But every one I could have added, I don't care how they performed in the past. I didn't even bother to look. I didn't even bother to optimize the systems once again to accommodate these new markets. Maybe I need to trade longer term or shorter term. No, none of that. So I will say though that the bond market sector is the smallest of my allocations of the four, and it's just because it's fewer markets. I think and I trade all the bonds you could possibly imagine, and then ETFs, junk bonds, tips, corporate, short-term corporate, short-term junk, mortgage backs. Yeah. And so That's 35 total. I mean, it's not that many. And I have 60 commodities and 60 currencies, right? So it's, by definition, it's just the smallest. However, okay. But also I trade a handful of the short-term interest rates. And the ATR has exploded since we put those things on. And I did not cut back, right? Because we don't cut back. It was a trend from the beginning. I'm letting the trend run. So these positions are super large. So the initial allocation is relatively small compared to all the other markets or sectors. But it's out of my control when the ATR, and the ATRs only, and these moves got even larger. Then the ATRs were increasing. So if you're going to truly, truly let your profits run and not scale them back, then you can get into a situation where, unlike others who do vol management, correlation management, but they overemphasize a certain sector, you can get spanked a little bit as well because of this volatility and increase that I didn't adjust for. So I think the best thing to do is don't trade the bonds. For March, you don't trade the bonds. But then if you don't trade the bonds, they were very profitable last year. So, and I made less last year than I underperformed last year, having overperformed in 20 and 21s because, yeah, bonds are where the game is. And I kept thinking like that. People kept saying, this is the greatest year of trend following ever. And I was like, it's the greatest year for bonds in a long time, that's for sure.
So, just to mention, in my back tests, I'm allocating the same risk to each asset classes. Like, so the credit has the same risk, forex has the same risk, and the commodities have the same risk. And of course, the number of instruments are different on each asset class. So this means that I'm, when it comes to commodities and forex, I'm risking much smaller than the credit side of the things because the number of instruments are relatively lower there. But I figured the long-term drawdowns are smaller with an approach like that. When I as a short-term trader, when I approach these asset classes with the same risk, because you don't know in which market regimes which ones are going to work. And in my last year credit is definitely profitable, and what at the moment I'm not trading. I'm still uploading the stocks, but as far as I'm concerned, it's a correction that is worth having, given what has happened last year. Last year, as Jerry said, the credit is the most profitable asset class. So, so that's basically the approach that I take. I'm agnostic to each of those asset classes, and I allocate the same risk. And the corrections happen from time to time. And I understand that Richard and Jerry and a few others might be much more shy on some of the asset classes. Thanks.
Yeah, I must admit, I don't have a significant allocation. I've only got 2 bonds or bond derivatives in my portfolio. And when the decision really was not only based on the lack of availability of these products in the particular instruments I trade, but it was also based on the fact that I think, to me at least, logic prevails to say that there is probably less trending opportunities in bonds because they're all influenced by interest rates. So they're all very correlated. So I tend to shy away from an equal allocation into the various asset classes, and I would prefer to sort of dominate my portfolios in commodities based on the fact that they are very uncorrelated, as individual markets as well as an overall asset class. So I'd tend to have a higher weighting in my commodities and a lower weighting in my bonds, just through logic. But I'd be interested to hear what other people think.
Hi everyone. Glad to be here. I I like what you're saying, Rich. I do overweight my portfolio with commodities, especially because they have this uh, diversifying capability. Uh, and I was wondering, first of all, uh, uh, you guys were commenting on the overweight on fixed income by the large CTAs based on their past performance. And I was wondering what happened to that mantra of past performance is not guarantee of future returns. But anyway, I suspect they overweight the bonds because of an expected diversifying ability, just like we prefer to overweight commodities. And as we like to systematize everything, I was trying to think of a method to diversify the portfolio. From what I get from you guys and from my own reflections, I tend to do this in a very discretionary way, to be honest. I try to think of things that are different from on a subjective basis than everything else. I don't know. Orange juice is potentially different from stocks, from bonds. So that's why it has its place on my portfolio, just like coffee, just like sugar. But how much different? How can we assess difference? What if this difference over time slips away? What if, I don't know, people start using oil derivatives to produce orange juice in a way that the orange juice future becomes really correlated to the crude oil? I don't know. Do you, and by the way, I believe that the method these large CTAs use is to rely on correlations and the covariance structure. But from what we know and from what we see, this is a really crude way to approach this. I honestly, I do prefer to do this the subjective way we discuss, in that we separate the portfolio in buckets and try to think about use some common sense to define these buckets. And one bucket is for commodities, the other is for financials. Within the financials, there are stocks, there are bonds, there are currencies. Within the commodities, there are the grains, the energies. Just do some common sense. But how about systematizing this common sense? What do you guys think?
Well, okay. I think I'm just going to repeat everything that I remember from all the other past conversations I've had, especially with Richard and Richard Dennis. And okay, so I think a few months ago, I was paying too much. I figured out that I was paying too much attention to smoothness and correlation. And I had a few markets in there that I was trading larger than the other ones because I felt like, they offer more diversification. And then I got to thinking about what Rich has said and what I learned in 1983, where we just used the same unit size for every market. And so we had one orange juice and we had 5 currencies, but we traded all of those markets the same size. And so I think for all of us, like, and no one, well, not no one, but let's say I have 300 markets, okay? And like, there's almost so few people who could outdo me on diversification. And yet my opinion of diversification is ho-hum, so what? I have more, but I don't care about it as much. I'm not looking at the correlations. I am maybe using a bit of discretion at the very beginning of setting my system up. And I'm trading all of the commodities possible. Randomly, it's whatever they offer me is what I trade. In the commodities, in the currencies, and in the interest rates. And I used to do the same thing in the stock indexes. So there was no discretion, or the discretion was, is it liquid enough? And I trade crude and Brent. And so I trade all kinds in silver and gold without regard to their correlation. So essentially what I'm doing is I'm appreciative of the correlation I might have, knowing full well that I'm over trading in some markets like the precious metals or the crude, but under trading in the softs. They deserve so much more if I gave a damn about smoothness. I don't. I like what I get for trade when I trade 300 markets. I like that I get a lot of diversification. But primarily what I'm more thankful for is the small bet size, because my my goal is not smoothness. It's finding those outliers. And my contention is sometimes silver will triple, quadruple in price and gold might not. That's right. It's 1987. Sometimes heating oil will double and crude will sit there. That happened more than once. That happened in 84 and it happened in 1990, December 1990. So then they go right back to causing me trouble because I'm not paying attention to correlations. So per my second mentor, Rich, small bet size. End of discussion. There's nothing else. What I don't like this bumpiness and knowingly over trading in markets. Well, I know I don't like it either, but that's the cost. And we're committed to trading each market the same size because we're not there to make money when a whole sector moves, like the interest rates last year. I'm happy about it, but that's not what my goal was. My goal was there could be 2 or 3 in that sector, or one that has an outlier move much greater than the sector as a whole. And maybe that kind of happened with the short-term rates, but it wasn't probably the type of outlier that I'm used to. I haven't really measured it, but 50 to 100 ATRs would be 50 would be my minimum. I don't know if any of them went 50. They might have. So I don't think so. When I realized, and I know it was after a Spaces, Rich was like, "Yeah, I don't really go with this over trading some markets larger than others." I was like, yeah, he's right. That's right. I had that one area in my brain, in my portfolio, in my strategy, where I'm still paying attention to smoothness. Get it out of there. So I got it out. And I don't want to pay attention to that. And I want to trade all these markets. Now, it's easy when you can just de facto say, I trade all the currencies, all the bonds, and all the interest rates. And that's what I do, trade them all. And I've gone a little bit further with the ETFs, okay? Now, you can't do that with stocks. You can say, okay, then I'm going to trade 2,000 stocks. So you have to exercise some discretion there. And the way I approached it, I said, what do these stocks deserve? 25%, 50%, 90% of my portfolio, what do they deserve? So I settled on 50 because they really are different. If you do some searching, you can find a lot of stocks that are commodity-based, metals, energy, things you can't pick up in the commodities in the futures markets. So you do have to make a very strong discretionary call. I think whatever you settle on, just don't change it. 25, 35, 50, whatever. I'm settling on 50. So I know I'll get in trouble sometimes because they'll all go down and I'll be long all of them. But nowadays I have a lot of shorts and a lot of longs. So I think the stock sector deserves, you can't trade them all like you do in the other 3 sectors, but you can trade. You have to make some sort of a discretionary call if you're going to trade individual stocks. But I'm going to stick with what I learned and what Richard reminded me of, and that is small bet size, nothing else.
Bruno, I've got an idea as well. I think there is a free lunch in this. So before we even consider market diversification across markets, now the difficulty of market diversification is that correlations are fickle between those markets, and we have no control over the degree of correlation across those markets. But the first step of diversification, I think, is system diversification. So the way I've tested this logic, and I can't fault the logic, so I think it's right, is that let's say that I'm trading one market with, say, $2,500 per bet, a fixed dollar bet per bet of a single trend following system. So any market I choose, I apply $2,500 per bet. This is before any compounding treatment. So just looking at this exercise over a 30-year period, I get a return stream and it displays a certain KGAR and it displays a certain drawdown. Then what I do is I break up that $2,500 bet into small bets, 5 small bets of $500 each. So in total, it comes to 2,500 risk. So then, but I deploy 5 different trend following systems, all with the same golden rules of letting profits run, etc., so they can capture those outliers, but they're targeting different areas of that outlier. And what I'm finding in every example I'm doing, I'm getting a better KGAR and I'm getting a reduced drawdown, and I'm not my risk exposure, because it's either 2,500 for a single bet or 5 times $500 bets with 5 different trend following systems. Every time I'm doing it, I'm getting an improvement. And what it's doing is it's breaking up the correlation structure of the return stream. So if you could imagine, if you're applying an ensemble of 5 systems per market, you get many more trades in that particular market because you've got 5 systems operating with small bet sizes. But the correlation in that market is different to the correlation of a single trend following system applying 2,500. When you map those two together, they're significantly different structures. And I find that the degree of decorrelation that occurs using system ensembles means that when you then look at the next level of diversification, which is market diversification, you've got less correlated relationships between the markets. So you can actually diversify farther across your markets. So instead of being able to do 50 markets with one trend following system, you can do 150 markets with 5 trend following systems. You get far more diversification, and it's a better bang for your buck, provided you look at system diversification as a means to break down the correlation structure of a single market. That allows you to diversify wider. I hope that helps.
Yeah, it definitely helps. Yeah, in a way or the other, we end up hitting the real world limitations. I mean, it would be awesome if I could trade 500 markets with 100 systems, but my minimum bet size to put one trade on limits me from doing that, and then I have to make some choices, and that's where the discretion comes in. And from I would just like to comment on Jerry's point. You're right. You can trade everything that comes to you, but even then, there is some discretion there, because imagine there is a whole term structure within each commodity. You can trade the first contract, the front contract of the crude. You can trade the second, the third. There is liquidity up to the 12th. You have a whole bunch of contracts in the interest rate within each interest rate market, but you choose 1, 2, I don't know, 3. There is some discretion there. I mean, so and we have our heuristics to choose the one that's most suitable for us. But I mean, can't we do better than that? Is there a way to systematize even this? I mean, why choose the I don't know, 2 years front for interest rates, or 5 years? I don't know what each of you would prefer. Why choose the first crude and not the second or the third? What if there is some juice there to be squeezed?
Yeah, I mean, I agree, but I think we have systematized it in the way that's important, and that is, and there's a couple of things that people keep complaining about and wanting to pick fights, semantic fights, and one of them was prediction, and maybe discretion was another. The prediction stuff, we do predict, we don't predict. You do use discretion. And I got to thinking, like, I don't really care. Yes, I agree. Whatever it takes to shut them up. Yes. Okay, cool. I absolutely use discretion because one of the things is it doesn't matter. It doesn't matter. You obviously have some discretion, not in the way that everybody else uses discretion, but it's fine because it's not humanly possible, probably. And there's nothing to really be gained by maybe systematizing some of these decisions. The most important thing is once you've made your decisions based upon the back test, based upon your common sense, reality of the markets, reality of your size of your account, all of these things, I'm totally fine if you just want to say it's discretion. That's fine. Now, do every trade. Follow these rules. Following the rules is what we're kind of getting at, not discretion. We get dragged down into some of these fights, and they're not worth 2 cents. But yeah, okay, whatever. We are using discretion to make these choices. And I used to, I know I was trying to figure out some ways to determine which month to trade, like you were just saying, like which Eurodollar month or crude month, and how can I handle these things? And then I said, stop that. I know what to do. What to do is to come up with an idea based upon diversification. I'm going to trade, like I'll trade the second month of the Euros and then 2 years out, both, and I'm done. Guys, just change the trade sheet and update those quarterly, and let's just go. And we got this power in having a rule, following the rule every single time, relative strength and all this other stuff. Just rely upon a reasonable idea, a reasonable rule, and just do the rule. And that's 90% of it. Having a reasonable rule and actually doing it and not changing. So, yeah, I don't think we need to get too uptight about the perfect systems and the perfect allocation and systematizing everything. The important thing, which is we're following these rules religiously 100% of the time, all the time, for the rest of our life. That's what we need to be concerned in. And there is this benefit we pick up of this power of being 100% consistent.
Yes.
Thanks.
So, just to mention, one of the values in these days of being a systematic trend follower is to become a technology company. So in Winton interview with the TTU, they were talking about the things that you can actually automate it. So I'm in the camp that it is better if you automate anything and everything else that can be automated. So if you have budget for it, if you have an appetite for it, execution. Yeah, why don't you do execution in an automated way? Why don't you do that? I mean, there is quantitative brokers. You don't have to use interactive brokers. Why don't you use quantitative brokers? It's more systematic. They've got more tools. And Jerry Parker mentioned that he's using actual human traders to execute his trades. But why? Why don't you just use computers to do that? Because that execution can be automated, right? And it is not very expensive to do that in this age. It's not like it's not like 10 years ago, 20 years ago. And also, I think we need to be selective where we are using the human brain, right? So choosing parameter set. Okay, is there a way of automating, systemizing? Is there a way of actually outsourcing that decision mechanism to choose the parameter set to a machine? Is there? I don't know. I mean, they were talking with the Winton and they said that they couldn't find one. But I believe, you could manage to be creative there as well, and you can actually outsource as many processes to the machine, isn't it? I mean, so that's important distinction. Are we going to do everything else to the machine and minimize brain? Yeah, I think it seems it seems a better choice. Why do we have to use discretion? Just minimize it. Start from execution. I think the trading will go better. Thanks.
Yeah, that's all great. Thanks everyone for the inputs. I was thinking that we're dealing with complex markets, and we do that by using our simple rules. And what Jerry just said, I don't know, flashed a light on me that you don't have to make it complicated. In this case of diversification, common sense does just fine. Yeah, thank you.
Hey everybody, Jerry, I was just wondering if you can just pick my stock universe for me and send it to me, and then that way I don't have to worry about it anymore and I'll just trade it. I just think the hardest part is figuring out how to pick the universe in stocks because there's so many options. I've been going around on this for about the last month, trying to figure out if I want to pick an index to choose from and then try to sort somehow. And I was also kind of wondering what your interactions with Chat GPT look like. I've tried to use it a little bit, and maybe I'm not asking questions the right way. Do you tend to ask an initial question and then ask follow-on questions, more like a natural conversation, or do you try to kind of get a list of attributes that you want to search in a stock and then put them all in there at once?
Yeah, well, I've learned a bit from Richard. He has been showing me how he's been using it. I think I need to take a course or watch YouTube videos on how people are using it. I'm always amazed at what's going on. There was this South Park cartoon where the guys were using it to respond to their girlfriend's text messages. So
That was funny.
yeah, that was pretty good. So I love that. But you can do both. I mean, like I'll say, for instance, I'm giving away too many secrets here, but I was a bit influenced a few weeks ago on the Spaces, I think, or maybe it was Twitter. Yeah, it was kind of Twitter because I know one person who said something that's never been on Spaces, and they were saying, I think Richard might have backed him up on this, or someone did. And it was this idea that maybe you'll get better trades, more outliers with smaller companies. And I like that idea. They assured me they had done this research that smaller companies will be better outliers. That's certainly my theory, that they're smaller and they give better outliers because they're not diversified and they have one business line, one business model that maybe something that fundamentally can hit it. And like eggs, they only do eggs. And so if egg prices do something, then you could see an outlier. So that was kind of my model. And I liked it even more, that idea, because it further reduced my universe, because it is burdensome. I've had the same feelings that you have, Seth, but I think I was wrong to have those feelings because, it's just as equally or not more silly to trade all the currencies. What? What other analysis did you do? I didn't do anything. Oh no, I just trade all of them. Why? Oh, max diversification. I'm hunting outliers. Oh, but when it comes to stocks, I have the opposite problem. I'm paralyzed. I can't move. There's too many. What if I make a mistake? Dude, what if you make a mistake by trading all the currencies? Well, I'm going for lots of diversification and hunting outliers. Well, choose your stocks, move on, have some sort of filtering mechanism. So I did reduce them somewhat by concentrating on anything below 10 billion market cap. Is that magical? No. And I was telling people the other day, look, I don't even know if it's going to work. I know that there'll be stocks out there who'll have massive uptrends that I won't trade because I don't have them in my portfolio. And they're huge. They're some of the biggest stocks ever. Once again, the key is to have this fixed universe, don't change it, and take all the trades and do the trades the same way for the rest of your life. And so that's what I concentrate more on. And I ask ChatGPT, for instance, I'll say, tell me all the stocks in the egg business, publicly traded companies in the egg business that have a market cap of 10 billion or less. And so it spits out that information. And then I'll think, oh, it left something out. And then I said to it yesterday, why did you leave out this company? And it says, oh, I'm sorry. Yeah, I did leave out that company. And here it is. And here's the information in the market cap. So another technical problem with ChatGPT is that it keeps reminding you over and over that its data goes through September 2021. So, and it's pretty good at follow-up questions, and it's pretty inconsistent at being consistent, because you can catch it in issues like that one and then sometimes it goes on, and you have to tell it to stop because it's giving you way too much information, and then sometimes it cuts off. But that's basically what I use it for, is that I'm riding in my car and I'll say, what are companies that mine salt? What are companies that process chickens? What are the companies out there less than 10 billion that sell guns and ammunition? I'm just brainstorming all the time, trying to create my own level of diversification in my head. And it works because a lot of these stocks, none of them look similar. They all look somewhat different, some in uptrends, some in downtrends. I think you get a fair amount of diversification just by doing it this way, and then you get another level of diversification by overlaying the trend following on top of it. So the key here is just choose your number, 25, 50, whatever you're going to trade in the equities, and be done with it. One of my best years of performance was 2013. I think it was 13. 14 was the crude short, and I had relatively amazing performance in 13 because I traded single stocks, and my universe was the S&P 100. All S&P 100 stocks, I traded them, and they had a tremendous move. It was probably the best year ever for those big stocks. So, yeah, once again, no matter what you do, it's going to not work sometimes, and then no matter how bad it is or unimaginative it is, it's probably going to work sometimes. So it's just this silly dilemma that I understand the SocGen 20, they have a niche business that they want to play along with this managed futures crap and vol management and watering it all down and appealing to people who want to allocate 5 or 10% to managed futures, to large firms who are doing ongoing research and play all these games. And I'm trying to create a portfolio that is the perfect portfolio, not allocating to Chesapeake based on to put me in a portfolio of traditional assets, but taking the traditional assets, the stocks and the bonds, and applying trend following to them to make that better. The 5% allocation is not nearly as good as taking the stocks and applying the good trend following to that. And it's not always going to work. As Richard said earlier, you've had these V bottoms. COVID was one, and there's other ones. There's been way more V bottoms where the market sold off and we didn't provide much crisis alpha and we lost money on the shorts. And all you had to do was just keep your stock longs on. There's been so much of that over the past 10 years that it doesn't look like trend following helps. And it certainly doesn't look like it works in trading the indices or probably even the stocks. So, however, I'm undaunted. And I know the right thing to do, but I just can't predict when the right things are going to work better than the wrong things.
I mean, in terms of this crisis alpha, when people are talking, the real question is if you are diversified in trend following space, okay? For instance, with my short-term models, so I make really huge amount of better performance when it comes to some of the V shapes because it's very quick, it's getting in and getting out. So I think the better way of looking into it is, you're going to look all the sorts of trend following models, with covariance models of Quantica, with short term, medium term, long term, and then the question is, if you actually have a nice diversification within the trend following space, are there any sort of crisis that we wouldn't be able to address in the last 20 to 30 years? So that's the kind of a question that I do have, because definitely 2020 is a very good example where short-term models done good. So there is no question about that. Some of the V-shaped bottoms, again, if it is very fast, short-term models pick it up very well. Some long-term models pick it up very well. So what sort of crisis that we cannot respond if we are looking into the trend following space as an overall, with all sorts of diversification into it? Are there any years, any particular areas, like 2018, for instance, is 2018. So I'm doing all right in 2018. I wouldn't say that it is my backtests are showing bad. So which type of crisis that we cannot actually address when we look into all time frames, short, medium, long term? So I'm not quite sure about that. So it feels like there is a trend following model that can address a particular crisis. It's just about finding it and diversifying into that model. I might be wrong, but that's how I think about that. Thanks.
When I think about that, right? When you think about a trend, the way I see it is trend needs time. So whenever you have a lot of whipsaw and a short of time, I don't think trend following works, because the market is not given enough time for the trend to develop into a certain direction. It's just going in one. It's just mean reverting. So I think very short. The way I'm thinking about it is trend needs time, and for time to run its case. So any event that is short lived, so to speak, and it's not really cascading to something that's going to permeate to a longer term or a longer trend, that's where that is. But I don't have a particular case to mention per se, but that's how I view it. Yeah.
Well, I don't really want to approach the markets in a using the word crisis, because it means stock crisis, and I don't care about stocks in particular. They're part of my bag of tricks, but I have all kinds of markets. I'm usually more concerned with some sort of bond market crisis that I experienced this month, or currencies and commodities. I'm not going to allow myself to get drugged down into this stocks are the be all end all and create your business to do something about this dysfunctional long only portfolio of stocks and bonds that people have. We can create so much more value for people by giving them what we know to be better, which is broad diversification, longs and shorts, and trading the individual stocks and bonds with trend following. So the question is, when is that not going to work? Well, I don't even think that's the question. I think the question is that can we do better? Somebody can do better. I can't do any better as relates to potential profit and preserving capital. So others can and do. The other famous firms that have lots of money in the management, and those kind of fund of funds, or funds of many traders. And so I refuse to get drawn into in speaking their language that's stock centered. Although I love stocks, I love them because of what they do for me personally, which is give me more risk control, more trends, and to the degree that they're helping me, then that's how much I love them. And so, I'm not going to ever look into. I'm never going to agree to be in their world and be a sideshow to their world of, can I allocate 5% to you? Change your systems. There's some of the CTAs on the Niels' podcast, which I thoroughly enjoyed all of those things. I just hope it's not over, and I'll go back and listen to them again. Even some of them admitted that what we've been saying for a long time, that you have to, on purpose, trade worse systems in order to increase your crisis alpha possibilities. And some of some of those traders do that. They on purpose trade a worse strategy, and then none of them will do the obvious, which is to trade single stocks and try to create more of a perfect portfolio versus a perfect hedge. So that's where I think that the world will go there, and the industry will change over time. It's just a matter of time. Business is always going to move towards a superior solution, better performance, lower fees, and we certainly offer a much superior situation than buy and hold and trading indexes in a managed futures portfolio and allocating 5 or 10% to that. It's kind of all kind of a bad idea of mismanaged futures. All right, I'm going to take the last word and move on so I can, I got to get out of vacation mode and into work mode today. And so I appreciate everybody being here and all the contributors, and I'll look forward to seeing you guys next Friday. Have a good weekend.